Welcome everyone to today's session. Today we'll be tackling on investments and we'll delve deeper into fixed income and also shares. So we can begin. So a little bit of housekeeping rules. So I'll be stopping after every stage and giving about 5 minutes for question and answers. And then in between, if you have a question that is really pressing, you can unmute and also ask the question. We also have a chat function which you can use to ask a question in between, and I'll be sure to stop and answer them. So my name is John Dua. I am an investment professional with over 8 years experience in the investment industry. My experience spans across investment analysis, research and investment management, corporate finance, and also a little bit of business development. In terms of my education background and qualifications, I have a bachelor's in actuarial science, a certificate in financial mathematics, and also a certificate in international introduction to securities and investments. So the first thing we need to understand during our session is the difference between what an investment is and what is not an investment. So basically, an investment is an asset or an item which you acquire with the goal of generating an income or appreciation. So what do we mean by this? The asset that you're acquiring is supposed to do the two things, which is generate income and also appreciation. Generating income basically means that it's developing a bit of cash flow that is coming into your account either every month, every quarter, or every 6 months or every year. It doesn't really matter as long as it's generating some form of cash flow. In addition to that, an investment will also be that the value of what you have bought, which is the asset, increases over time. And what do we mean by this? Is that, let's say, for example, you purchase a piece of land and you purchase the same piece of land for 1 million shillings. Then in over 1 year, 2 years, or 3 years, the value of that asset increases from the said 1 million to, let's say, 2 million. That increase in the value of the asset is known as appreciation. In addition to this, investments need to be tied to a goal. And what do I mean by this? When you make a purchase of that asset, it generating that income or the value appreciating means that there's a particular goal you want. Either, for example, you want to purchase a home in the next 10 years. Either you want to retire in the next 10 years and you want something to generate some form of income that will sustain your monthly expenses. Or maybe it's your children, you want to take them to school in the next, let's say, 15 years to a university, and you need to gain the capital to do that when the need arises. That is when now you should channel that particular goal towards an investment. In investing, there are 3 main objectives, with the first one being capital preservation, the second one being income, and the third one being capital growth. And the reasons as to why these objectives occur is because it stems from the goal you want to achieve. For example, let's say you have 5 million shillings and you want to buy a home worth 10 million shillings. You don't have the capital to do so now. So you put it into an investment. This investment is supposed to grow that capital from 5 million to 10 million. That movement is known as capital growth, and that is objective number 3. Scenario 2, let's say you want to retire in 10 years and you want to invest in something that will be able to pay for your monthly expenses. The objective in that kind of investment should be income. This investment should actually be generating some form of income to cater for your monthly expenses. And the final one is capital preservation. Let's just assume you have the money to be able to purchase that goal or to cater for the expense of that goal. However, the need for that goal is not now. You will need it in the next 5 years. For example, let's say you have 10 million in your account and that 10 million can actually buy a home. But since you know you'll be traveling around the world, whether for jobs, you cannot buy the house now. It will not do any good for you at the moment. However, in 5 years' time, you will need to buy that house. So what you need to do is set aside that money and preserve the capital. And that is what we call capital preservation. And capital preservation comes in two ways. Number one, that amount of money will not lose value. You will not come from 10 million and then you lose and then you come to 7 million. That means no loss on the principal. Number two, protection against inflation. And what do we mean by this? Inflation is basically the increase in prices of goods and services. So let's say that 10 million could purchase a house now, but that house in the next 5 years will not be worth 10 million. The price will have increased due to the effects of inflation. So you also need to put that money in an investment that will earn either equal or above the inflation rate for you to be able to achieve the same goal in the next 5 years. So capital preservation should be looked at it in two ways: the no loss on principal and also the protection against inflation. And when we talked about income, we need to talk about a reasonable interest rate. The interest rate should be linked or should be commensurate to the risk profile of that asset. And we're going to talk about each particular investment and their risk profiles. So any investment that you make should be commensurate to the risk profile. For example, a risky asset, let's say you are investing in real estate, should definitely give you a much better return than putting your money in the bank. That is what we mean a reasonable interest rate. It should match the risk that you're taking on that said investment. So this is now defining what an investment is. Now we know what an investment is. We know how to match our goals to our objectives, and we know what these objectives actually mean. Now that you understand this, the next natural thing to do is now to understand what are the investments available for me within the universe, within the investment universe. And that's what we're going to tackle in the next slide. Hello, Hassan, do you have a question? I see you have unmuted. Okay, great. So the next stage is to talk about the investment types. And the investment classifications, we have two major ones. We have traditional investments and we have alternative investments. So what do they mean? Traditional investments basically mean investments that are available to you on a public platform. Basically, these are investments that you can just go on a public platform and purchase or sell if you held them. And what is this public platform that we are speaking of? The public platform here is the Securities Exchange. And in most countries within Africa, we have several securities exchange. In Kenya, we have the Nairobi Securities Exchange. In Uganda, we have the Uganda Securities Exchange. In Tanzania, we have the Dar es Salaam Securities Exchange. So all these exchanges usually have securities which you as an individual can go and purchase. And which ones are the major ones? We have two main ones. We have equities and we have fixed income. These two will be the basis of our discussions today. We're going to learn about equities in depth, and we're going to learn about fixed income also in depth. So what are equities? Equities is also known as shares and also known as stocks. You might find across those different terms, but they refer to the same thing. So what are equities? Equities are basically ownership in a company. And since we are talking about traditional investments, these are ownership in public companies. And the next natural question will be, what is a public company? A public company is a company that is listed on that public platform, which you call the securities exchange. So any company you find in that exchange is by definition a public company. So when I buy shares into a company like Equity Bank or Safaricom or EABL, I am basically buying ownership into that company. I am becoming a part owner of that company. And being a part owner comes with its advantages and disadvantages. So what is the advantages? The advantages is if the company performs well and records a profit, I am eligible to participate and earn some income from that profit. Number two, since I'm an owner, I am supposed to make decisions on specific or strategic aspects of the company. So all shareholders convene every year in a meeting called the annual general meeting or an AGM, where they decide or vote on specific decisions on the strategic direction of the company. It could be either acquisition of other companies, it could be either expansion into other areas, it could be the decision to employ directors. That is on the discretion of the shareholders. So that kind of investment also has some characteristics, some positive, some not positive. So the positive ones include it's very liquid. And what do I mean by it's liquid? If I buy shares,
is correct also.
You have unmuted. Kindly mute yourself. Thank you. So with regards to the characteristics of shares, they are liquid. And what do we mean by being liquid? When you buy shares and you want to sell them and get your money back, you can sell them within a week. That's the aspect of liquidity. Liquidity is actually defined as being able to convert your investment to cash within a short period of time. The second feature, the price is visible on a securities exchange. What do we mean by this? If I want to buy shares of a particular company, I don't have to do my own personal valuation. I can actually go to the market and see the price at which it's being bought and sold at. And the securities exchange is very transparent in the sense that this price, you can go back up to the point where the company was listed and see the daily price of that particular company. So it's not only visible today, you can also see the historical data. Number three, since it's an investment, it pays out returns and pays out returns in two major ways. It pays out returns in dividends and pays out returns in capital appreciation. Dividends, remember, is a share of the profit I spoke about earlier, and capital appreciation is the increase in the price of the share. Let's say you bought the share price at 20 and now it's at 30. That increase is known as capital appreciation. However, equities is also affected by many things in addition to or external to the performance of the company. It can be affected by political turmoil. It can be affected by the mood of the market, how people are trading on the particular stock. It can even be affected by misinformation. And this makes equities to be a very high risk investment. So before you make any investment in equities, you need to understand that it involves a little bit of high risk. So the second major asset class in traditional investment is fixed income. So what is fixed income? Fixed income is basically an investment under which the person who is borrowing the money is also known as the issuer, is contractually obliged. So there is a contract that is signed with regards to this particular fixed income security. They are contractually obliged to make payments on a fixed amount on a fixed schedule. What do I mean by this? Take an example of a loan. If I take a loan from a bank, I'm supposed to pay that loan interest payments on particular periodic payments, either monthly or quarterly. And the loan takes a particular fixed schedule. It's for a particular period. It's either a 1-year loan, 2-year loan, 3-year loan, 4-year loan. It doesn't really matter, but there is a fixed schedule. So that's what we call fixed income. So fixed income is an investment to the person who is giving out the money. So for a loan, the bank is the one giving out the money. So it is an investment on the bank's perspective. However, from your perspective, we have things we call bonds, and we're going to talk about it in this particular session. And you can see how you can actually invest in bonds and get a similar type of arrangement. So what are the characteristics of a fixed income security? Number one, they are also liquid. So majority of the fixed income securities we have are either government securities or corporate. Corporate meaning that they are issued by companies. So they are liquid, meaning if I buy a bond, I can sell the bond within a week and get my money back. Number two, the price is also visible on a securities exchange. Within the exchange where the bonds trade, you can always go and see what the price is for that particular bond. And you can also go back and see even 1 year, 2 years, 3 years, at what price that bond was trading at. You can also have a historical record of the movement of the price. And number three, it being also an investment pays out returns in two major ways, being the coupon and the principal. The coupon being the interest payments and the principal being the amount of money you actually invested. In most bonds, the principal is paid at the end of the maturity. Fixed income is quite easy to understand and it's quite straightforward. And also in terms of ranking, it ranks higher than equities. So what do I mean by this? If you give your money as an investment to a company in the form of a fixed income, and another person gives the same company money in the form of equities, the fixed income investor is supposed to be paid first because they are not an owner of the company. The owners of the company get after everyone is paid. So all the debtors, all the suppliers are paid, then the equities holders can participate in that profit. Fixed income are supposed to be paid regardless of the performance of the company. They are supposed to be paid. It's a contract that says I'm supposed to be paid this amount on this particular fixed schedule. And because of that, the risk involved with fixed income is usually lower. In general, if you include the government, it's even much, much lower. Now, the other investment classification that we have is known as alternative investments. And what is alternative investments? Ideally, these are investments that are not available to you on a public exchange or a public platform. These are investments you have to engage on a one-on-one basis between you as the person who wants to invest and the owner, the person who is selling. You need to engage on a one-on-one basis. And with this, we have two major ones. We have private equity and we have real estate. And I will start with private equity. Private equity is basically the same as equities. The only difference is that you are buying a private company, while in equities, you are buying a public company. And private companies are companies that are not listed on the public securities exchange. So if I want to buy a company like, let's say, Java, or let's say Quickmart, or let's say Naivas, I have to engage the owners on a one-on-one basis to actually get to purchase or invest. There is no public platform where they are trading. And with this comes the following features. Number one, it's very illiquid. What do we mean by being illiquid? It means that if you want to sell and get your cash back, you have to take a long time. In fact, you have even to look for a buyer because they're not lining out somewhere. You have to look on a one-on-one basis. And it can also take up to a year before you actually make a transaction. Number two, it is very difficult to price. What do I mean by this? There is no public platform where the price is being shown. You have to engage valuers for you to actually determine the price of that particular asset. Number three, there is lack of availability of transaction data. Remember, on the traditional side, I said you can even go back 5 years and see at what price that particular asset was being bought or sold at. For private equity, transactions are private. So it's up to the discretion of those people involved to actually disclose. If they don't want to disclose, it's within their rights. And most of the time they do not. So you can't go back and see how much that thing was trading. And number four, being an investment, it also pays out returns in dividends, and pays out returns in capital appreciation. Considering that whole process and how difficult it is to actually invest, the risk involved in this particular investment is also high. Now, the last asset class I want to talk about is real estate. And real estate is basically something that we are very familiar with. And here, real estate is defined as land and any permanent structures on it. What do we mean by permanent structures? I mean like something like a home, an apartment, an office building. It could be a retail center with malls, with shops. It can be a factory. As long as it's permanent, that is also part of the real estate asset class. Now, real estate is very, very cumbersome in terms of the acquisition process. It requires a lot of moving parts. You will involve lawyers, you will involve valuers, you'll also involve the government in terms of checking the land registry to see whether the land belongs to those people who are selling. And because of that whole process, people tend to tire in between. And a lot of fraudulent cases happen with the land and also real estate. And with this hardness in acquisition process, the level of fraud is quite high. So we need to be very careful. Real estate requires a bit of time and a bit of lengthy due diligence before we can actually make any decision. So what are the features? Number one, it's very illiquid. What do we mean by illiquid? The same thing. It's very hard for you to sell or takes a long process before you can actually get your cash back. Difficult to price. Remember, you have to involve valuers to actually determine the true price of the asset. And also, you cannot check the previous transactions if that asset has exchanged hand multiple times. So the lack of availability of transactional data is also a key feature of this particular asset. Number four, the payout is in terms of rental payments. If, for example, it's an improvement or you are leasing the land, so you get monthly rental payments, or capital appreciation, the value of the property can also increase. However, given the fact that real estate requires a lot of due diligence, involves a lot of people, the capital committed is also very high, the risk is also very high. You risk losing a lot of money because of the nature of the process required in real estate acquisition. Even if you don't make the transfer, you'll have to spend some few coins, even if you end up not even making that decision. Some money will be spent. So the due diligence process is actually also capital intensive. So now that we have classified the various types of investments, now, and you have known their risk profile, the next thing to do is now understanding yourself as an investor, understanding what is your risk profile and what are your goals in order for you to determine which investment I'm going to take. So the next stage is to determine your risk balance. And how do we do this? We have three main criteria that we use to determine our risk profile, with the first one being risk capacity, the second one being risk required, and the third one being risk tolerance. So what do we mean by the three? I'll start with the far right. What is risk tolerance? Risk tolerance is your emotional and psychological comfort with risk. So as an individual, how do you handle risk or risky situations? Are you comfortable with them? Do you shy away from them? That really speaks about your personality and whether you are able to take risks. The second one is the risk capacity, which basically speaks about your financial ability to bear risk. I'll give two scenarios. You have scenario one, an individual who earns 50,000 shillings and spends 40,000 shillings on his monthly upkeep. Then you have individual two who earns 1 million and spends half of it, which is 500,000, on his monthly upkeep. You will see that those two people have different financial capability. One is left with 10,000 shillings to either invest and do any type of ventures. The other one is left with 500,000. They have such a different risk capacity because of how much you earn. So we really need to understand also that risk capacity is not, or our risk profile is not necessarily involved or tied to what we are as an individual. It is also tied to how much we earn. If you earn less, your risk capacity is lower. If you earn higher, then your risk profile tends to actually increase. And the final one is the risk required. So what do I mean by this? This is directly tied to your financial goals. So let's say, for example, you have 9 million shillings or 9 million in whichever currency you operate in cash. However, you want to purchase a home worth 10 million, as an example. That is scenario one. Scenario two, you have 1 million in cash, but you want to purchase the same home worth 10. You will find that scenario one, you are so close to your goal. You don't really need to risk your money. You are so close. You can even put it in the bank, earn a few interest here and there, and get to your goal. However, if you had 1 million and you're supposed to achieve the goal of 10, then you really, really need to put or take a little bit of risk for you to actually have that capital growth to achieve that 10 million. That is what we call risk required. And it's directly tied to the goal and how much financial or how much money you have to achieve that particular goal. And all those three should be taken in equal measure. And then you'll have your risk profile. However, at the end of the day, we can accurately define our risk profile, but invest in the wrong asset. And this will arise because of our risk perception. Our risk perception is basically having subjective judgment on the risk of an asset. Maybe you think real estate is not a risky investment, but on all objective measures, real estate is actually risky. So you'll find yourself investing in a venture that is mismatched to your profile. So you need to be very objective, and at least we have learned about the risk profile of those various asset classes and take it as the truth assessment of the risk profile of those particular assets. And you will be able to invest in the best asset that suits your actual profile. So once you've defined your true balance or your true risk profile, it can only come in these three areas. You could be either conservative, you could be either moderate, or you could be aggressive. So what do I mean by each? Conservative, it means you have a low risk tolerance, low risk capacity, low risk required. So you are conservative. You don't really need to take risk. So you will invest in the low risk investments. Moderate, it means you have a moderate risk tolerance, moderate risk capacity, and moderate risk requirement. So you are in between. You can mix around. Aggressive, it means you have a high risk tolerance, high risk capacity, and a high risk requirement. So you take a high risk investment. And with that, you need to be also cognizant of the fact that return, it tends to follow the risk. So a high risk will most give the highest return, and a low risk will give the lowest return. However, the opposite is also true. If a high risk investment does not work out, you can also get a high loss. And if a low risk investment does not work out, your losses are also minimized. So you need to understand that high risk is commensurate with high return, but also the opposite is true if you invested without the proper due diligence. And in this session, we're going to learn about those two asset classes, equities and fixed income. And we're going to get to know how we can do the actual due diligence and assessment to actually make an informed decision. So before we proceed to the fixed income section, I'd like to take a moment to pause and pose any question to the participants based on what you have learned so far. So if you have a question, kindly take this moment to ask it. You can use the chat function or you can unmute if you have a question. So we'll give it a minute to see if there are questions and then we'll address them as they come.
Oh, thank you. Good morning, Jonah on the call.
Yeah.
I will want to inquire something about in relation to fixed income or equity for that matter, but this is particularly in relation to what called the central lending rate. You find in every country, probably the central bank has a certain ceiling or threshold of the lending rate.
Yeah.
But when it comes to the commercial banks, they also put a different rate.
Yeah.
I only want probably you to clarify if the central bank gives, let's say, 15%, what makes the commercial banks go to 25? That is one. Number two, if, for example, you want to invest, let's say, on fixed term in the bank, you find you are going to dance to the tune of their rate compared to what the central bank rates are. Could you kindly clarify why those kind of variations are?
Okay, thanks for that question. So the central bank rate, we need to understand what it is actually. So the central bank rate in most economies is the rate at which banks borrow money from the central bank. Okay, that is what the rate means. So if the central bank puts the central bank rate at 15%, it means that the banks are actually getting money from the central bank at 15%. So they cannot loan it at the same 15 since they're also in business. So they need to loan it at a higher rate. That's why they put 20, 25%. That is the reason why they put it as such, because 15% is the rate they are getting the money from the central bank. That is why. Number two, if you're going to a bank and putting a fixed deposit and you're getting to dance to their tune, the reason for that is that if you go and think about it, you do not have the economies of scale to negotiate with the bank. You have your 1 million, you have your 5 million, it's not enough for you to negotiate. Most banks put the level of amount of money with which you can negotiate at around 100 million. And here I'm speaking here in Kenya. I'm not sure about the other countries. So if you don't have enough money, you cannot negotiate with the bank. You just take what they give. That is the reason. Okay. Any other question? Good. I think we can now proceed to now the fixed income section. So, fixed income. In this particular section, we're going to define what fixed income is. We're going to look at what is available to us in terms of investment options. However, in terms of the analysis, we're going to tackle specifically on government. And the reason for that is because government represents almost 99% of what is out there. So it's basically everything. So that's why we're going to delve into government bonds specifically. But in terms of the definition, we're going to talk about treasuries, and we're also going to talk about the corporate bonds. So where does fixed income come from? Why do these things exist? Why is it an investment? So think about your normal government. Your normal government basically has a budget, and they create a budget every year. And this budget is supposed to define where they're going to spend the money. Example, the government will say, we'll spend half of it on recurrent, half of it on development. Recurrent means we're going to spend on salaries, we're going to spend on debt repayments for debts that we are supposed to pay now. We're going to spend on any recurrent expenditure, fuel, those things, travel. That's what we call recurrent. Then there's development. Development is basically building bridges, building roads, infrastructure, hospitals, schools. That's what we call development. And they attach a figure to it. Let's say 1 trillion. But that is just expenditure. They need to collect that money to spend. So where are they getting the money to spend? Number one, tax revenue. Tax is revenue for any government. They tax their citizens to collect revenue. So they tax you, they tax me, they tax companies, they tax foreigners, they tax importation, they tax everything. And that is what's supposed to collect the money. However, it's not enough to cater for the entire budget. Let's say it's 700 billion. So there's a deficit of 300 billion that the government needs to get from somewhere. That is when they borrow. And they borrow using things called fixed income securities. So what are they actually? So it's where the borrower, which is the government, says that they are going to pay you a predefined amount in terms of interest payments for a specific period of time. So they are borrowing the money for, let's say, the next 5 years. That is what we call a fixed income security. And the government uses two major ones to usually borrow. They use a treasury bill and a treasury bond. So what is a treasury bill? Treasury bill is short-term fixed income security. They issue 91-day, which is 3 months, 182, which is 6 months, and 364, which is 1 year. So they basically come and say, and they do it every week, we need to borrow 24 billion Kenya shillings. But we will pay you in the next 3 months. So you give them their money, your money rather. And then at the end of the period, they pay you your money plus the interest. That is what treasury bills are. And remember, treasury bills do not trade. So if you buy, you will stay with it until the end of the period, and that's when you'll get your money. Number two, they are offered at a discount. What do I mean by this? You tell the government I have 100 shillings as an example, and it's supposed to be 14% interest. So the government will not take the entire 100 and give you back 110. They will take 90 and give you back 100. That's what we call discount. So they deduct the interest and take the money less the interest, and then they pay you the 100. That is what we call discount. Just a simple concept. I'm sure most people, if you are in Kenya, I don't know if the other countries have it, something called Okoa Jahazi. That's the same thing. If you borrow 100, they will give you 90, and then you'll have to pay back 100. That is what we call a discount ideally. I think that's the best way I can show you from a practical example on a day-to-day item we use. Now, it is the most less risky item in fixed income. Is the least riskiest. Number one, because it's offered by the government, and number two, because it is very short term. It's either 3 months, 6 months, or 1 year. Number two, they offer treasury bonds. And what are bonds? Bonds are basically long-term fixed income securities. It can be a 2-year, it can be 5 years, it can be 3 years, it can be 12 years, can be even 50 if they want to issue. But anything that is long-term is called a bond. So what is the major differences between a bond and a treasury bill, other than the length? Now, because they are long-term, they pay interest in between. So every 6 months, you get an interest payment into your account. Remember, treasury bills you have to hold until the end. Bonds, they pay interest in between. Number two, they also trade in the sense that you cannot stay with the bond for the long term if you don't want to. You can actually sell it to another investor in the secondary market. And the secondary market is what we call the securities exchange. You can even buy and you can even sell if you have one. So that's basically what bonds are. And remember, treasury bills are issued every week here in Kenya. And bonds are issued once a month. Every month there is an issue, but only once in those particular months. Treasury bills is every single week there's an issue of a treasury bill. So anything with a treasury in front is issued by the government. Anything with a corporate is now private companies. So everything I've talked about in terms of treasury bills and treasury bonds, except for the fact of how many times they are issued, is the same for corporates. So a corporate bond is the same as a treasury bond in terms of how it works. And a commercial paper is the same as a treasury bill in terms of how it works. They are similar. The only difference is government issues treasury bills every week and treasury bonds every month. However, corporate bonds and commercial papers, they just arise when the company wants to raise money. They don't have a schedule through which they are issuing them. That is the only difference. But in terms of how they work and what they are basically the same thing, just issued by different people. One is government, one is corporate. And based on the issuer, you can basically tell government is less risky than corporates. Corporates are more risky because it's a company, it's not basically a government, ideally. So I'll stop here for a second and see if there are any questions with regards to this definitions and the examples before I proceed. You can unmute if you have a question, or you can use the chat function. Okay, great. So from this point going forward, we are going to discuss about basically the government securities. So we have two major markets which you as an investor can participate. Okay, I've seen a question. Maybe before I proceed, maybe you can talk about the tax implication of each. I will talk about the tax implications. It's actually a part of the next slide. So I'll discuss about the tax. Another question, when do we expect bonds to be with a higher interest rate? I honestly do not understand the question there. What do you mean? When do we expect bonds to be with a higher interest rate? Maybe, Rasom, you can unmute and ask the question. I'm not understanding the question. Yes, I can hear you.
Yes, John, I was implying the government comes up with bonds, especially when there is limited fluidity for them to invest. And we hear sometimes 20%, sometimes 25%. So for us to time the best, which situation should we consider to invest in bonds so that the return is a bit higher? Thank you. Okay. I hope it's clear.
Okay, yeah. So I think the question is maybe basically what makes interest rates to go up? Because basically you can't basically time it, but what makes interest rates to go up? So there are several factors that make interest rates to go up. Number one is government appetite for money. Ideally, if you see the government struggling to make payments in their budgets or collect money, then they will be desperate. And when the government is desperate, they will tolerate higher interest rates. Another area to look at in terms of risk. If your government is perceived to be risky, the interest rates will definitely rise. Another scenario is looking at inflation. If inflation is on the rise, then basically the interest rate will continue to rise. But remember, this interest rate rising is a measure of risk, ideally. So sometimes interest rates being high does not mean that you're going to reap high returns. Sometimes it could mean that the government is more risky and they don't have the capacity to pay. It can lead to that particular scenario. So what you need to be looking at is looking at stable interest rates, not high interest rates. Looking at stable interest rates and low inflation. So even if your government is giving 10% and your inflation is 1% or 2%, you're still making a good return of around 8%. But if the government is giving 50% and your inflation is 48, you're getting 2. So it doesn't really matter. What matters is stable interest rates and low inflation. That's what you need to be looking at. So other kind of questions. The other one is, one second. Is the fixed income security worthy for government or individuals? Also don't understand the question, but if you're asking me, is it worthy to invest in fixed income? Then yes, fixed income is actually a very stable way for you can get some level of income that is very predictable and sustainable. So it is very worthy if you want to invest in it. But if that's not the question you wanted to ask, you can also unmute and ask, but I believe that's the question. What are the basic conditions for one to purchase a treasury bill? You basically just need to have 50,000 shillings. Even though we're going to talk about it, you need to have 50,000 shillings and open an account with CBK. How often does central bank communicate about treasury bills being issued? Every week. And where can we get this information? Good question. You can get the information from the central bank website. They also have a WhatsApp channel where you can subscribe and get these messages on your phone. However, I'm only speaking for Kenya's example. For the rest, what I'm very sure of is on their central bank website. With regards to other communication channels, I'm not so sure. Does the government sometimes use the treasury bills and bonds to control inflation in the economy? Yes, they do. They do it by, it's called mopping up liquidity, collecting money from the economy to reduce the amount of money within the circulation to now reduce inflation in the economy. Yes, they do that sometimes. What is compound interest? How is it calculated? Okay, so I feel like most of the questions here now are deviating from the actual conversation we're having about investments. So we'll do this. If you have a question that is quite different from the actual objectives of the presentation, let me tackle them at the end. I'll have a session, I'll give it 30 minutes, and I will tackle them individually, the questions that are sort of kind of different, and then I'll explain it. But just to keep it quite simple for the people who are here for a specific information, let's first tackle that, and then if you have additional questions, we'll spend the last 30 minutes and we'll answer all of them. I hope that is agreeable across the board, because I believe we are now deviating from the actual conversation we're having here. Great. So I'll take the last 30 minutes to discuss anything that is maybe kind of not related here, but anything that's related to the actual conversation we are having, we can discuss in between, but I'll spend some time. I will not leave you hanging with your questions, basically. Thanks. So I think now we can proceed to the difference between primary and secondary market. So in fixed income, especially for government, we have two major markets. We have primary market and we have secondary market. So what is the primary market? Primary market is basically where the government is borrowing money for the first time. And it's held by the central banks. So here's when the government wants to collect money, and they issue the bonds for the first time. So that is called the primary market. The primary market is run by the central bank. Number two, we have the secondary market. The secondary market is where the people who bought the bonds in the primary market are given a chance to sell to investors within the secondary market. So that's called the secondary market. It's now the people who are holding the bonds can sell it to other investors. That is the difference. So how does the money move in those two scenarios? So in scenario A and B, those are the people transacting. A is the government, B is now the initial investors. The government issues a bond to collect 1 billion. So investors give the government 1 billion and the government issues the bond. So what is the bond exactly? What is it exactly? The bond is basically a contract that says the government collected 1 billion from you and they're supposed to pay 10% of that 1 billion for the next 5 years. So that is a contract. That's what the bond is. Now investors B hold that contract. Now investors B can decide, I need money and I can't wait for the next 5 years for the government to pay me. So I sell it to other investors. So what happens is investor B tells investor C, if you want this contract where the government is supposed to pay you 10% of 1 billion, I'm going to sell it to you. And the selling price could be either higher than the 1 billion or lower than the 1 billion, depending on the demand for that particular return. So investor C can now buy from investor B. So the transaction between A and B is known as the primary market, and the transaction between B and C is known as the secondary market. Remember the primary market I explained? For treasury bills happens once a week, for bonds happen every single month, but for secondary market happens every single day, except public holidays and weekends. So B and C happens every single day except public holidays and weekends. A and B happens every week for treasury bills and every month for treasury bonds. Primary market is held by the central bank. Secondary market is held by the Nairobi Securities Exchange and any exchange in any country. That's how it works, ideally. So, when you want to invest in fixed income, there are several terms that you will come across, and you need to understand what it means. So I'll start with the first one. The first one is called par value or face value. What is that? What does that actually mean? So basically, par value is the principal amount that you're paying, the amount that you give, let's say, for example, the government, which is supposed to pay you at the end of the term. That is known as the par value or face value. So in simple words, it's also the principal, ideally. What is the maturity and tenor? The maturity and tenor is the length of the bond or the loan agreement. Some people call it maturity, some places they call it tenor. It means the same thing. Now, there's these two concepts, coupon rate and yield, that I want to explain to you. They might look similar, but they are quite different. So what is a coupon rate? A coupon rate is the interest that the government promised and is contractually obliged to pay the investors, either semi-annually or annually. So the coupon rate is basically determined in the primary market. Remember, when the bond is being structured and being contractually struck, that the government borrowed 1 billion and they're supposed to pay 10% of that 1 billion. That 10% is what we call the coupon. The government is contractually supposed to pay 10% of 1 billion for the life of that bond. That will never change. That is what we call the coupon rate. It is what the government will pay the person holding the bond. However, remember, a secondary market exists where I can sell my bond. So let me give an example. I have a bond, I bought 100 shillings, and I'm supposed to get 10%. The coupon is 10%. So the bond says the government is supposed to pay 100 shillings at the end of the 5 years, but pay 10% of that 100 shillings every 6 months. That is called the coupon rate. Does not change, will never change. However, what is yield? If I hold that bond for the full maturity, my yield will be 10 because there's nothing that's changing there. However, imagine I decide to sell it in between. However, because I'm desperate for money, I sell it for cheap. I sell it for 90 shillings. Remember, I was supposed to get 100 shillings at the end, but now I'm getting 90 shillings. So my yield is lower because I forfeited my 10 shillings because I wanted the money earlier. That's what we call yield to maturity. And the person who is getting the bond will still be paid 10% of 100 until the bond matures. So the yield arises because of buying and selling prices, if it's higher or lower than the face value, which we discussed in the first part. That is what we call the yield. And then we have also tax. Remember, the government collects taxes, and they also collect taxes on interest payments. So for bonds longer than 10 years, they charge 10% withholding tax. And for bonds shorter than 10 years, they charge 15% withholding tax. Okay? So that tax is called a withholding tax. It's withheld. So you will receive your interest rate, but less 15% tax if your bond is shorter and 10% tax if your bond is longer. The reason why they tax longer bonds less is because they want to incentivize people to invest longer. And the reason why the threshold is 10 years is because if people invest longer than 10 years, that's an issue of the next government, and it's not their issue. So it's a political reason why they chose 10. But the reason why they chose a longer period to charge it less is because they want to incentivize people to invest longer, and they don't burden themselves in the short term. Additional, some bonds are tax exempt, like IFBs, infrastructure bonds, they don't pay taxes. So if you're getting interest, you'll get the full amount. And additionally, if you invest in a pension, also pensions are not taxed. So pension schemes get the full amount also. So this answers the question about the taxes, and you can see what the taxes are in respect to the tenor of the bond, in respect to the type of bond, and in respect to the fund that you're investing in. Okay, so I'll give it here a pause and ask a question. And you can ask a question if you have any questions with regards to the fixed income terms. You can also unmute or use the chat function to ask a question. But please, let's keep it related to this particular section. Yeah, thank you. Okay, so I assume that was well understood. So we move on. So we're going to talk about treasury bills and treasury bonds. We're going to try and understand how they work, how they are issued, and basically how you should bid for them, ideally. So basically, treasury bonds and treasury bills are issued using a bidding system. So what do I mean by a bidding system? A bidding system is basically where the government gives you a minimum amount that you should bid at. For treasury bills is 50,000 Kenya shillings here locally. So 50,000 shillings is the minimum with which you can actually bid for a particular investment. And there are two ways they offer you a bidding. You can either be competitive or non-competitive. What do I mean by competitive? With competitive, I mean you give the 50,000 shillings, but you also say what rate you want the government to invest, or you want to invest with the government, or the government to pay you. That is called a competitive bid. A non-competitive bid, which is advisable to retail investors, is when you give the amount and accept the average of the other bids. So that is what the bidding system works, and that's how it works. So treasury bills are issued every week. So before you put your bid, you need to look at the performance of the previous weeks. And this is an example of one. So you'll see that the government wanted to collect 4 billion in the 91 day, 10 billion in the 182 day, and 10 billion in the 364 day, bringing the total amount to 24 billion. And you can see 14.8 billion was for the 91, 9.4 for the 182, and 5.6 for the 64 in terms of bids. So 91 day is more attractive to investors because they got 370% of what they wanted. and the rest they got below 100%. So why will people want to invest in the 91-day? There's only two possible reasons they can do so. Either the rate is higher, or they are perceiving some risk with regards to the government. And you can see with all the protests going on, people tend to invest in the short term because they are unsure. So they just want to see what's going to happen. So the 91-day is more attractive. However, you can see that they only accepted 12.8 billion of the 14.8. Why is that? It's because of the competitive bids, some people put in an exaggerated rate. Maybe they put in 20%, and the government said, we cannot accept that. It's too high for us, so we'll reject your bid. So this is one of the reasons why we recommend people to bid non-competitive, to avoid being rejected by the government because of outrageous bids. So also remember when I talked about the discounting, so for the 91-day, for every 100 shillings the government is supposed to pay you, you will have to pay 96.2, or rather invest. For the 182, you have to invest 92.3. And for the 364, you have to invest 85.6 shillings. For every 100 shillings the government is paying you on maturity. This is a concept of discounting. And I've compiled a small exercise just to see whether we understand this particular concept. So here it goes. Take a few seconds to look at this particular assignment and see whether we understand what discounting means. So imagine you want to invest in a 1-year treasury bill to receive 100,000 upon maturity. What is the actual amount you need to invest if the current rate is 14% per annum? So take us a few moments and see whether we understand what discounting works. If we get it wrong, we will discuss it much further. But if we get it right, we can move on. So suppose you want to invest in a 1-year treasury bill to receive 100,000 upon maturity. What is the actual amount you need to invest if the current rate is 14%? So take a few minutes to use the chat function. Okay, I see people have the same answers, 86K, 86K. Anyone else with a different answer? Or 86K? Great. Think now we understand it. Basically, straightforward. 86K is basically the answer. And this is the calculation. So this is how they calculate. So they look at basically the amount of money, which is 100,000. They apply the 14% interest rate. They get 14,000, and they deduct this from their 100K. So you will invest 86,000 and you will receive 100,000 at the end of the period. So that is what we call discounting. So also remember the government issues also treasury bonds, and they issue treasury bonds on a monthly basis. And every month they have to issue a bond, and every bond has a document we call the prospectus. And this is how a prospectus looks like. It's just a snapshot. It gives the amount of money, the purpose of what the money is supposed to be used for, and gives also the payment schedules, gives out the minimum amount to be invested, which is 50,000 shillings, and also gives about who you can place the bids with, and also gives other details. So it's always good to read the prospectus because it gives you insights on what the bond is about. So this is basically how a normal result looks like. It tells you and gives you a snapshot of how actually the bond works. So the government wanted to borrow 20 billion. Remember, the government wanted to borrow 20 billion. And they received bids worth 20.7 billion. So they received more. They received apparently 103.72% of what they wanted to borrow. However, they accepted like 500 million less because the bids were too high. Remember, it's the same thing. And of this, We have competitive and non-competitive. Remember, the suggestion is we always bid non-competitive. So you can see that the market weighted average, this is the average of the bids, all of them, including the rejected, 14.259. And the weighted average of the ones that was accepted is 14.228. So now, this 14.228 will now become the coupon rate of the bond. This is what each and every investor who bid for this particular bond will be paid. Each and every person will be paid 14.228% of the amount of money they invested. So let's assume the amount of money they are to invest is 100. So each and every person getting the bond will get 14.228% of 100. Okay? However, remember, there are people who bid higher and there are people who bid lower. So those people need to be neutralized and harmonized in the middle. So if I bid a higher rate, I'll have to pay less. So I'll pay 96 shillings to get 100 shillings worth of a bond. And the people who bid lower will have to pay more. They will pay 105 shillings worth for 100 worth of the bond. So what does that mean? It means that if you underbid the government, you will be required to top up. If you overbid and the government accepts, the government will tell you to pay lower. So you will be given a discount. And that is the reason why we tell people to bid non-competitive, to avoid all those complications as to you overbid, so you pay lower, or I underbid, so I have to pay higher. And remember, if you don't have the money to top up, you will be blacklisted. So always remember, it's much easier and much simpler for a retail investor to just bid non-competitive, to avoid all those complications and calculations that really do not benefit you in any way. So it's much better to bid non-competitive. And that is the recommendation I am giving here. Don't go bidding competitive and you end up losing. Just bid non-competitive. It's the only sure bet way of getting your bid accepted and paying the exact amount you actually bid for. So don't do that mistake. So we have several risks involved with fixed income. And these risks come in many ways. However, with fixed income, they're actually very minimized. They're very low. They're not so high because they usually tend to be very safe investments. The first one is inflation risk. Basically, this talks about when inflation is high, the real value of your money actually goes down. So you need to get an interest rate that is higher than inflation. So that's what you need to do. Get an interest rate that is higher than inflation. Number two, liquidity. With government bonds, this risk is very low, but I'll just define what it is. Is the point at which you can fail to sell your bond and get your money back. It is very, very low for this to happen, but it's a risk that can eventually appear, but very, very low. The other one is exchange rate risk. If you're from Uganda and want to invest in Kenya, remember, investing in fixed income, you have to invest in Kenya shillings in Kenya. You have to invest in Uganda shillings in Uganda. You have to invest in Nigeria naira in Nigeria, Rwandan francs in Rwanda. So you have to actually invest in the host country's currency. Now, what happens if that country's currency depreciates against your home country's currency? You are losing money because when you convert it back, you get less. So you need to be very cognizant of the movement of the exchange risk or exchange rate with respect to your country's exchange rate. If I invest in Nigeria and the currency depreciates against Kenya shilling, I will lose money. Even if I'm getting 50%, I will definitely lose money because of the exchange rate risk. The other one is seniority risk. And seniority risk basically means that some bonds rank higher or some fixed income rank higher. Things like bank loans rank higher than any type of security in a company. So if a company is failing and they have to be liquidated, they will have to pay all their bank loans before they even pay a fixed income security or even the shareholders. So banks paid first, fixed income second, shareholders third. So that's what we call seniority risk. If the money is not enough to trickle down, you might get less of what you invested. So we also need to be cognizant of seniority risk. Second is default. There's a possibility that the issuer will not be able to pay the coupon back. So for government, is that the government will not be able to pay. For corporates, that the company will not be able to pay. It's very low risk for the government not to be able to pay. However, we have seen governments fail to pay. So it's not zero. It is low, but never zero. The other one is price risk. Price risk is that when you're selling it in the secondary market, the movement of prices change, and that's the interest rates. So you might end up selling your bond at a loss or end up selling your bond at a profit. So that's a risk that exists. So on the secondary market, this is a major risk that exists. Ideally, it is price risk, that actually exists. Liquidity risk is quite low. Yes, I think Kidinji, your question, I think illiquidity is a real risk in the secondary market, especially when interest rate rises. Actually, no. When interest rate rises, the price of your bond goes down. So people are actually buying it at a low price, remember. When interest rates rises, price goes down. So people are actually buying it at a low price. So the demand is even higher. You could say that illiquidity exists when interest rates go down. That could be a risk, but not the other way around. Remember, interest rates go up, price go down. Interest rates go down, price go up. Yeah. Okay. So now
No,
I think
I think what I meant is, for example, look at the bonds that were issued maybe when the interest rates were like 12%.
yeah.
And now the interest even for treasury bills have gone to 14%. So those people who are holding those bonds at 12%, if they want to sell it in the secondary market, it becomes a bit of a challenge, because why would I buy a bond at 12% when I can go to the market and get it and get the same even in the T-bills at 14%?
Yeah, but you see, you're buying it at a lower price. So effectively, you're getting that 16%, aren't you?
No, but you see, these are bond holders who, with the bonds which are issued with coupon rates of, let's say, 8%, because they are long term,
Okay, let me give you an example, Basim. Let's say you have a bond, right? It's giving 12% for 100 shillings, okay? Hello?
Yes, I'm listening. Yes.
Yeah. And then now the bond is, let's say you're giving 10% for 100 shillings. Let's just say 10. And then now the bonds in the market are giving 15%, right?
Yes.
If I go and buy the bond that was giving 10%, I'll definitely buy it at a cheaper price, right?
Yes.
And that cheaper price will reflect the current interest rate, right? So if I buy it at, let's say, 80 shillings and I get 10%, but I bought it at 80 shillings, you see my interest is basically 15.
Yeah, but my question is, for me, holding that bond, I will be losing.
Yes, but now it does not, let's say you don't want to sell, you want to hold it to maturity. But sellers really want to sell. If I want to sell, I have to sell. If I need money,
that's why I'm saying I will be losing as the one selling. So it will force me to hold it to maturity.
I really do understand what you are saying, but if I need money, I need money. I will not hold to maturity and I need money. That is the reality of how it works. If I need money, I'll sell it at a loss. That's how it works.
Yeah, that's now where I have an issue in fixed income, because now the disadvantages.
Yeah,
the bond holder,
reality.
Yes.
Yeah, that's the reality, exactly. Another question, please. I think we use this time for the questions. You can use the next 7 minutes for questions before we break. You can use the chat function. Yes, thank you. I see Anushka. That should not be your only source of money if you need an emergency fund. Okay, that's good, Anushka. I think that's a really, really good point. Yeah, if you have an emergency fund, then you can actually be able to hold it to maturity. That's a very good point. Thanks for that. Any questions within the first section? Okay. So if there are no questions, I can try and start tackling the questions I left earlier. And the first one will be on compound interest from Judith. So basically, compound interest is basically, I won't give the actual formula here. I'll just explain to you the concept. When you talk about simple interest, is that, let's assume like a bond gives simple interest. You're getting 10% for 100. So every year you're getting 10, 10, 10, 10. That is simple interest. Compound interest is that the interest that you're getting each year is added back to the principal. So I invested 100 shillings. This year I earned 10. That 10 is added to the 100. Now it's 110. Now that 110 earns another 10%. So the interest will also earn interest. That is what we call compound interest. That is the concept. The other question is from Edward. On money markets, how come there is a huge difference on the interest rates, 9 to 16%? That's a good question. And I think we are discussed here with the other, with my colleague here, Kithinji. We have old funds, and these old funds hold the old bonds, and they don't want to sell it at a loss. So that's why their interest rate is lower, because they have the old bonds. If you really look at the interest rates for the money market fund, look at the top ones. They are the new companies, because they entered in a situation where the interest rates were higher. That is why they are offering better returns. It's not that the other guys were doing the wrong things. No, it's just that they have the old bonds. So they have to wait it out. That's the reason. Yeah, you can see such a huge disparity. And the new funds have a higher interest rate. That is why. Good. So I think if there are no questions, we can take a small break and then we convene back the next 10 minutes. So it's 12:27. Okay, Judith has a question before we continue. Based on what you explained, when is the right time to buy the bond? When the interest rate is high or when, okay, it's best to buy the bond when the interest rate is high, because when the value drops, the price will go up. That is why it's better to buy a bond when the interest rate is high. But now my question to you, Judith, will be, what is high to you? To some people, 5 years ago, 12 was high. Now it's at 16. When it gets to 20, so what is high? What is the benchmark? That is the question.
Yeah, thank you, John. I think for me, it's dependent on the current market. So just looking at what is trending in the market, and then you decide when to buy or when not to buy. Because I saw the arrows facing up and down, and I was thinking, okay, would I be considering high interest or low interest? But you've explained it very well. So thank you.
Okay, great. Okay. Any other question before we take a short break and then we come back to the equities part? If you do have a question, kindly ask now before we break, because the equities will completely take you on a different direction. So if you have a question, please ask now. We get through with it before we go to the equity section.
Yes, John, I have a question concerning the bonds.
Yeah.
As the government is lacking money, and then he come to the market and buy the bonds. Then when where will he get the money to pay back this bond with the interest?
Good question. Good question. So the government collects money in two ways: taxes and more debt. So I hope that answers you. So they will tax people or get more debt to pay old debt. Okay? So this debt thing is usually a cycle. It goes on forever. So I hope, Peter, I've answered your question. The government gets the money from taxing its citizens and getting more debt.
Yeah, it answers my question because the debt will continue for years because we cannot finish it at once.
Exactly. To just be pushed on to the next people, the next people. That is how it is. But in terms of income, the government income is basically taxes, ideally. But the idea is this. Let me just give you the idea, because the idea is, it looks like it's a bad thing, but let me give you the idea. The idea is the government is supposed to borrow debt to do infrastructure projects and to build hospitals and make it easier for people to do business. Now, when people do business, they get more income, you can export more, you can do more productivity. And when they do more productivity, they earn more and they have a more capacity to be taxed. That is usually the idea, the concept. As a concept, it makes sense. But because of the total amount of wastage in government, those investments are not usually actualized. That's why the debt keeps on building and building and building and building. But as an idea, it actually makes sense, because if roads are built, I can plant more, I can earn more, and I can be able to pay back more, ideally, if most of the money was going through development. But most of the government money goes through recurrent, so the actual answer is more debt and more debt. Yeah. So the next session will be on equities. We're going to learn about what equities are, where do they arise from, what steps and what type of analysis do we need to do before we can actually analyze equities as an investment. And then we look at the case here in Kenya, and we look at what it takes to actually make an investment, the charges involved, and the process also involved. So when dealing with equities, we are basically dealing with companies. And these companies are basically corporate companies, either public or private. That's why we have equities in the traditional sense, and we have equities in the alternative sense. So how do we raise capital? We raise capital in two ways, which is debt and equity. So what is debt? Is what we have just discussed, fixed income. Basically, debt talks about a company going either to a bank, issuing a bond to individuals like you and me, and raising money, which they're supposed to pay back. However, the company could also raise money through issuing shares or ownership, where a company will say, we want to raise money, but the people who are giving us the money will become part owners of the business. That is what we call equities. Also, we also have hybrids of the two, where investors could decide, I'll give you money as debt for the following 1 year, and if the business does well, we can convert it to shares. That is called a hybrid. However, the major ones are debt and equity. So when talking about equity, we will concentrate on the public side, which is listed equity. And when you talk about equity, you're talking about businesses. And these businesses basically operate in an economy. They operate in countries, they operate in an economy, they operate in an industry. And with this, there are two major types of businesses. We have public businesses and we have private businesses. So public businesses are businesses which are listed on a securities exchange. And being public comes with a lot of requirements. You have to publish financial information. You have to make announcements on major company events. Basically, you have to disclose a lot of information about the company to the general public. Being a private company, you do not have to do that. You just comply to the normal laws of the land and you can keep your business private. So how do you become a public company? Because all businesses start private and then they transition to being public. So how do you become public? Number one, you start with an IPO. An IPO is also known as an initial public offering. The other way is known as listing by introduction. So what is the difference between the two? An IPO or an initial public offering is where the company says, we are going to issue new shares to the public so that we can raise money. So they say, we as the shareholders of this private company, we need to raise money to expand our business, but we want to collect this money from the public. So we will offer them shares in our company, they give us money and they become shareholders. That is what we call an IPO. But what is listing by introduction? I am a private company. I decide I don't want to raise money. However, we have so many investors within our company that need a platform where they can sell their shares whenever they want to. So we just move the shareholders into the public platform. It's called listing by introduction. And with that, both companies are able and will be entirely listed in the securities exchange and be available for trading. But the difference is one raised money, the other one did not raise money. That's how this particular section works. Now, investing in equities, albeit in whichever way, will give you a return. Not guaranteed, but are expected to give returns. And these returns are dividends and capital gains. So what is the difference between the two? What is dividends? Dividends is essentially when the company makes a profit, the shareholders, under the discretion of the directors, can be paid a share of the profit, either in its entirety or a part of it. So these amounts are either paid quarterly, half-yearly, or even yearly. The amount is not fixed. Like I said, the company can decide to pay the entire amount of the profits, or they can decide to pay a part of it, like half of it. So the amount is not fixed, it changes. It's also determined by the directors. The shareholders do not decide whether they're going to be paid a dividend. It is the directors who they had employed, remember, during AGMs to determine the strategy of the company. They're the ones to determine whether the shareholders will be paid a dividend. It is also driven by profitability. How? If a company does not make a profit, be sure more often than not, they will not pay a dividend. So it's driven by profitability. That one you should be aware of. In terms of how it's expressed, it can be expressed in absolute terms, like 20 shillings per share, or as a dividend yield, like 10% of the share price. That's just an expression of how much they're going to pay. And they are not always paid, like I said. The other type of return is called capital gains. And what is this? So basically, capital gains is when the share price rises above the price at which you bought the share at. So if you bought the share at 20 shillings and the price rises to around 30 shillings, that is known as a capital gain. But remember, in shares, prices go up and down. So you could also get a capital loss when you bought the share at 20 and now it's 10, That is called a capital loss. However, in both scenarios, if you do not sell, that loss or that gain is said to be unrealized. It exists on paper, but you have not realized, it's not yet in your pocket. You can only say it's realized when you sell the shares. So capital gains can only be converted to cash flow when they are sold. Okay? So those are the two ways in which you can get money or can get returns from shares. So when you talk about equities, there are several myths that usually are around with regards to equities. Stories, tales about this, how they work, this, how they do. But today I'm here to talk about the top 5. What are these 5 myths that are so common that we need to address and see if there's some truth in it? So you'll find that generally from a survey, these are the top 5 myths about equities. These are what people are saying out there and maybe do not have the full understanding with what they mean. So in this particular slide, we're going to talk about it, and we're going to dispense each and every particular myth and talk about it and explain what it means. So we'll start with the first one. Investing in stocks equates to gambling. This is a half-truth in the sense that if you invest in stocks without the proper understanding about, number one, the company, the industry it operates, the management, the track record, then you are gambling. However, if you invest and you have that information and you have done your research and analysis properly, then you are not gambling. You're actually making an investment that is actually properly informed. Number 2, the stock market is exclusively for experts. No, it is not. The stock market is not exclusively for experts, and I'll explain what that means. Even you and I can understand from a basic point how to identify and how to analyze stocks in a more professional and a more informed way. You don't really need to be an expert because the process is quite simple. Number 3, you can only make money by investing a lot of money. That is true in a way, and I'll explain why it is true in a way. In terms of the rate of return, it is the same. If you are getting 10% from return from a stock, we will all get 10%. The only difference is 10% to someone having 1 million and 10% to someone having 1,000. Those are two different in terms of quantity of money. So of course, the impact of 10% on 1 million is much, much higher. That's why it's true in a way. When you have more money, you tend to reap more benefits from investing in stocks because of the quantity of money. Number 4, high risk means high return in the stock market. Not necessarily. If you invest in the stock market with a well-informed background, then yes, you can able to reap high returns. However, if you don't do that, you can also get high losses. So it's not necessarily true. And number 5, good product equals good company equals good stock. That is definitely not entirely true. There is the aspect of good management that is often very underestimated. If you have a good management and a good product, that will most definitely breed a recipe for a really good company. However, if you have a bad product and a good management, still not so good. If you have a good product and bad management, the company is not good. So there needs to be a balance on how we actually do things. So now that we know what stocks are and the various myths about stocks, I'm going to talk about the process that we take in terms of understanding how to pick stocks from the stock market. So how do we do this? The stock market usually has a lot of companies, a lot. It's very hard for you to pick a company in the stock market and make an informed decision just by looking at them. What you need to do is look at economies. We have people from different backgrounds from different countries. So what we need to do is we need to identify countries that are doing well politically and economically. And we need to be very objective. We are looking at maybe African countries who are doing well in terms of economically, they are growing, they have very strong industries. Politically, they are stable. We are looking at that. Number two, sorry. Once we have identified the countries, we need to look at the industries within that country, because not all industries thrive in all economies. So we look at countries like Kenya, Uganda, Tanzania, Ghana, Nigeria, Rwanda. Look at the industries within those countries. And when you look at those industries, you need to tell yourself which industry will thrive in this particular country for the next 10 to 20 years. And it needs to be very well informed. You need to look at things like, is the industry underserved? Is the industry having high demand? Is the industry being supported by the government? Is the industry adapted towards technology? You need to look at so many aspects for you to determine which industry. And if you look at the case of Kenya, you look like things like agriculture, you look at industries like healthcare, industries that adopt digitalism. You look at these industries and you look and you know that these industries will survive or will thrive for the next 10 years. And with that, you can identify an industry that resonates quite well with you. And with that industry, you can now identify the companies within that industry. Because the stock market is segmented into industries. We have banking, we have telecommunications, we have agriculture, we have manufacturing, we have hospitality, we have so many things. But your sector will help you determine the companies within that particular industry. So once you do that, it's the point where you now identify, now I have 10 companies within the industry I have identified. So how do I determine of these 10 companies, which one is a good company? And in determining that, you need to look at two things called the should haves or good to haves and the must haves. The must haves, I'll start with that. These are things that need to be a bare minimum within a company for you to even look their direction. Should haves is now a bonus. This is a bonus additionally to what we are doing or what this company is doing. What are they doing additionally that makes them a really good company? And I have compiled a list of several aspects that you need to look at for companies based on must-haves and also the should-haves. You will find that in must-haves, you need things like profitability, innovation, competition, things like legal. Are they up to date with the regulations or are they unregulated? Socially responsible and environmentally sound. This mostly affects guys in the manufacturing sector. Are they really socially responsible or they're just polluting the environment here and there, which means that they're not sustainable, which means in the next few years, the government will catch up to them and they will stop them in their tracks. These are the things you need to look at in companies to make sure that when I make these investments for the long term, 5 years from now, I will not be caught off guard by something I should have caught it 5 years previously. And what are the good to have? Things like branding, things like difficult to copy in terms of their business model requires a lot of effort for anyone to replicate. Flexibility, if another COVID comes, can they still operate in the same manner or they will still struggle? Those are the things you need to look at in terms of additional good to have bonuses in a company. If a company satisfies both those two things, then this company is definitely a good business you can actually invest. But in reality, we might not have the amount of money to invest in all companies that are good. We might have limited amount of money. So how do we analyze companies that we have identified are good companies and worthy to invest, but I can only invest in one? This is where fundamental analysis comes in. And what is it? What is this thing that we're designing as fundamental analysis? This is basically the process of looking at businesses at the basic financial level. It is very basic that anyone with the right knowledge can do it from the comfort of their home and identify these companies. In this section, we're going to look at three key ratios. Three key ratios that define companies' fundamental worth from a basic analysis. And these key ratios include earnings per share, price to earnings ratio, and dividend yield. I'll repeat, earnings per share, price to earnings ratio, and dividend yield. And we'll go through each and every single one and understand what it is, how do you calculate it, where do you get the data to calculate it, and what the implications are. So basically, earnings per share is basically the profitability of a company. First of all, now we know if a company is making a loss, it should not even appear here. So the profit after tax of that company and the recent financial year divided by the total number of shares. So what is earnings per share? It tells you how much profit this company generates for every single share. So a company with a higher earnings per share is more profitable, yet then better. So where do we get this data? Profit after tax is provided in the company financial statements. Remember, this information is disclosed by the company in their financial statements, which they publish on their website. Number of shares is found on the same document on their website. So the company with the higher ratio is the better company. So earnings per share is an indication of profitability. Hope that is clear. Number two, price to earnings ratio. So what is price to earnings ratio? This is the share price of the company divided by the earnings per share you got in the previous calculation. What this tells you, or this scenario, what it gives you is, for example, you're walking to two merchants and they're both selling the same type of potatoes, but one merchant is selling at a cheaper price than the other. Of course, you'll buy the cheaper one because it's the same thing, but it's selling at a cheaper price. It's a better value for money. This is what price to earnings does. It tells you of the two companies, which one is offering you a better price. And where do you get the data? Market share price is gotten from the Securities Exchange. You can always go and see the latest share price. And earnings per share, we already calculated. So remember, this one is a price ratio. So the lower, the better. When you're looking at price, the lower, the better. Now, the final one is called dividend yield. So basically, dividend yield is the dividend per share divided by the share price. Dividend per share is found in the financial statements, and the share price is found in the Securities Exchange. So you definitely want a company that is paying higher dividends. So the one with the higher dividend yield is the better company on this particular metric. So the higher, the better, because it gives you much more income to work with. So I'll start again. Earnings per share tells you about the profitability of the company. So the higher, the better. Price to earnings tells you what price am I actually buying these shares for. So the lower, the better. And the dividend yield tells you how much money am I going to earn in terms of dividends from this company. So the higher, the better. So now I'll show you how to calculate them and how to collect the data, because it's easier to do it in this manner. So these are the various data once you have identified the two companies you like. And in this case, we're going to choose between equity and KCB. This is how you compile the data. You compile the price for the two companies, and you get that data from the Securities Exchange. For equity, it was 40.2, and KCB 21.95. And this is dummy data, so don't use it as the truth. This is just dummy data. Number of shares. Equity has 3.7 billion shares. KCB has 3.2 billion shares. You get that data from the annual report or the financial statements of the company. Profit after tax. Equity 46.1 billion, KCB 39.9 billion. Where do you get the data? From the annual statements or the financial statements. Dividend per share. Equity was paying 4 shillings per share, and KCB 2 shillings per share. You get the dividend per share. So now with this data, you can calculate those three ratios using the formulas we calculated. And the results will look like this. For equity and KCB, the earnings per share is 12.22 and 12.42 for KCB. Dividend yield will be 10% and 9.1%. And price to earnings ratio will be 3.29 and 1.77. That's just the data from the calculations using this data. So this is the result, ideally. So now the question will be, remember, earnings per share is a measure of profitability. Dividend yield is a measure of income. And price to earnings ratio is a measure of price. So you definitely want these two to be higher and this one to be lower. So based on that and looking at it individually, don't apply more weight to one. Which company do you think is the better company to invest in? Remember, this one is higher the better, lower the better. I'll repeat. Remember, this one is higher the better, lower the better. And you look at it in equal measure. So the one which appears better in most wins. So which one is a better company? Great. I think now it's very self-explanatory. KCB is basically the better company to invest in because it has a higher earnings per share, meaning it's more profitable, and has a lower price to earnings, meaning it's cheaper. The dividend yield is much lower, meaning the income coming from equity is higher, but you're paying more for that income. Ideally, that's what it means. So KCB is better. However, it does not mean that equity is a bad company to invest in. This is just a way for us to decide on how to choose from two good companies if I want to choose between one. Okay? So this is how we do it. You look at the companies, you look at the ratios, and you make that decision based on these particular ratios. And KCB will be the better value for money, but not necessarily the better company or better by miles away. Equity is also a good company. Great. Okay. So what I've just shown you is what we call the fundamental analysis. And here is where you look at economies to choose which country you want to invest in. You look at the industry to look at which industry do I want to invest in. And then now you go to the company performance to choose between the companies I've identified which company is the best decision for me. Then we have other factors that affect the market that we might not really be in our control, but will really affect the company. Things like interest rates within the money markets. If fixed income is performing well, people will prefer to invest there. So people will tend to sell their shares. And when people sell, prices go down. Mood in the market. Are people worried about the political environment? People are worried. People tend to sell. People tend to be pessimistic, what we call bearish. So they sell. What is the supply and demand? How many people want to buy? That is a demand. If demand is high, price goes up. How many people want to sell? That is supply. If supply is up, price goes down. It's natural economics. Even about who's trading. Companies with high institutions tend not to sell their shares. But companies with high amount of retailers like Safaricom tend to sell and tend to have a lot of activity. And things like euphoric behavior, this is basically people getting information that might not be true, that will spark some form of excitement about a particular stock, which might drive prices up, and yet is not driven by fundamental factors, which will mean that that price will go down. So looking at these factors will tend to help you understand whether this company is actually proper to invest in. Also, another thing that we need to be cognizant on, and this is something that people need to be very, very, very clear, and I need to be very clear on this. Investing in stocks is a long-term endeavor. You invest in stocks for 10 years on average. The reason for that is that stocks tend to rise on the movement of the profitability of the company, and they tend to give out dividends based on profitability. So dividends are paid annually. So you need to wait for those particular incomes to come for the company to pay you dividends. And prices rise over a 10-year cycle. That is just how it works. So, and they will also drop on a 10-year cycle. So you also need to be acknowledging for that factor. So you need to be waiting for a longer period for you to actually reap from the investment in particular stocks. So how do you go about investing in stocks? Sorry. You can invest directly, and you can invest by buying an equity fund. What I spoke about earlier was buying directly. If you want to get exposure into shares, you can actually do it directly. However, do as I said, it's a long-term investment. Do your analysis fundamentally, and also pay attention to market factors that might affect your stock. However, there's another way, and we're going to discuss about this type of funds in the last stage of the presentation. You can also buy an equity fund, and an equity fund will also give you exposure in shares while delegating the day-to-day analysis. So you don't have to do this analysis I'm speaking of if you buy an equity fund. However, I will speak about the advantages and disadvantages of this particular fund, and you'll get to understand how you can actually get exposure to it and how you can balance based on who you are as an investor. So earlier on, we spoke about the risk factors about investing in stocks. And those risk factors, I can speak to them, but I can also show it. And this current table shows you the actual risk involved. If you look at 2023, you will see that it's mostly red. Red means that it's people losing money. And in 2024, which is represented by this year to date or YTD, it's mostly green, which shows you that most people this year are making money from stocks. So stocks are very, very erratic, and they are affected by so many, many factors. And some of them might be external factors. So investing in stocks, it really takes a high-risk individual to actually sustain this type of performance. Because one year you are losing heavily and the other year you are gaining in the similar manner. So we need to be very, very aware that stocks is very, very risky. You can know people are making money, but you can know also people are losing money. So before you invest in the stock market, you need to be very, very aware that this is something that actually happens and it's a reality. So you need to look at this and make sure that you understand that this can happen to you. Okay, so stocks basically happen in the secondary market, majority, 99%. And in the secondary market, you have to use a broker or an intermediary who is licensed to purchase stocks. And when you're purchasing stocks, the following charges apply. So you don't have to write it down, we'll share with you. This is for Kenya's case. These are the charges that apply. So for every amount of money you're spending, you need to add these charges. And in addition to that, once you sell your shares and you had capital gains, you get a capital gains tax of 15%. And if you get dividends, there's a 5% tax on dividends. So we need to be very, very aware that there's additional charges when it comes to these fees. So it reduces the return that you're getting. And if you're making a loss, it increases the loss. Hope you understand it also works that way. So it reduces your charges, your gains, and increases your losses because you have to pay it from your pocket. The other one is normal debt. Apparently, if you want to do it on a secondary market, fixed income also comes up with charges on brokerage commission, the levies involved, and they appear so, even though they are much less than stocks. However, the taxes are 15% for bonds with less than 10 years to maturity and 10% for bonds with above 10 years to maturity. You also pay withholding tax on the interest payments. So tax is much higher here, but fees is much higher on stocks. So I'll stop it here for a second and welcome questions with regards to stocks, if there are any, before we proceed to now the final part, which is now understanding our implementation options for both stocks and fixed income. So I'll take a few seconds for questions with regards to equities. Okay, so if there are no questions, now we have sorry. Catherine here. Do I retain my principal investment in case the company gains no profit? So Catherine, when you're investing in stocks, you have invested or bought the shares for, let's say, 20 shillings. If the company makes a profit, there is no direct link on the principal. The principal depends on the movement of the share price. So if the share price goes up, your principal will increase. It doesn't matter in the sense that a company can make a loss and you still gain a principal, can get an increase in principal. You're basically not investing in the company directly. You're just buying shares from other people. The only instance you're going to invest in the company directly is if you do it in an IPO. But the other time is just buying and selling from other investors. I hope that is clear. Profit or no profit, that has no direct link on your principal. Great. Any other question? Good, good. So now we have talked about what investments are. We have talked about fixed income, and we have talked about also shares. So that's why, what if the company goes into bankruptcy? Is the individual going to receive the principal? When the company goes to bankruptcy, everyone else will be paid before the shareholders. So if there's no money left, the shareholders will not get anything. The shareholders get the minimum or the last thing that the company will have after they pay all their debts. Equity fund has some serious lose. That's good. Good. So I hope, Tesfaye, you understood what I said. The risk involved with investing in shares is that when a company goes into bankruptcy, the shareholders are paid last. So you'll get what is left. That is the risk involved with shares. Right. So let me delve into this and then we can tackle the question after. So here you have two options in which you can implement in the market if you want to get shares or bonds. You can do it directly. For bonds, remember there's the primary market and the secondary market. For shares, we have the secondary market. You can go and invest directly. Open an account with a broker for the secondary market. For the primary market, open an account with the central bank. And you can actually buy and sell shares, and you will own them directly. However, there's another way in which you can invest in a fund, and that fund does those investments for you. And this is what we call collective investment schemes and unit trusts. And they come in very many shapes and forms. We have equity funds for those people who are buying shares. We have fixed income fund for those who are buying treasury bonds and corporate bonds. We have money markets, which is the majority, but they invest in bank deposits and low tenor government securities like treasury bills. And we also have balance funds, which invest in shares, bonds, and money markets in equal shares. So it's balanced. But what are they really? What are they really? So each of them, collectively, they are called unit trusts. And what they do is that they collect money from very many investors. And the point of collecting this money from these many investors is because the fund has an objective. It's either to invest in shares, invest in fixed income, or invest in fixed deposits. But now, how does it operate? It has and managed by a professional fund manager who invests that money in several portfolios. It can be stocks, bonds, and any other instruments. So their work is to invest the money for you. But how will you benefit? Why will I do it? Why can't I just do it directly? Why do I need this structure? And I'll explain. This structure is so unique in the sense that the unit trust pulls money from very many investors. So what advantages does it have? Number one, the person who asked me the question, why does banks not give you the interest rate? You have to fall into their tune. It's because you don't have the economies of scale. Unit trusts do. So if you even put 1,000 people or 10,000 people with 100 shillings each, they are pulling their money and they have a lot of money. Now the unit trust goes to the bank as a unit trust. It does not go to the bank as investor A, investor B, investor C. So the bank knows that this unit trust is giving me 100 million, so I'm giving them a return. And that return will be distributed to all those investors. So you see, even with your 1,000 shillings, you can participate with high returns because you're part of a unit trust. Number two, it employs the following people: fund manager, custodian, and trustee. What are their work? The fund manager is supposed to invest for you. These are people who are licensed and qualified to make investments and also do investment research. Number two, custodian is the legal safekeeper of your money. It's mostly a bank. So what do? When you're depositing money, the fund manager does not hold the money in the account. The money goes to a custodian bank, and the custodian bank receives instructions from the fund manager to make the investments. So all the securities are held with the custodian. Now, who is a trustee? Now, the trustee is now the overseer. They monitor the actions of the fund manager and the custodian to see if they are doing the correct thing as per the regulations. So they get daily reports on how they have been doing their work. And based on that, you can always see, you can just see that this is ring-fenced. Each person has their own duty, and the person who is investing does not touch the money. The person who has the money has no mandate to actually make investments. And the trustee does not even touch the money or make investments. They just oversee. So this structure is so secure that money is so hard for your money to actually get lost. Now, how does the money move? You as the investor, you invest in the unit trust and you get units in the proportion of your money against the total money. So if there's 100 shillings and I put 10 shillings, I have 10% of the units, ideally. If I put 100,000 and the money has 10 million, I have 1% of the unit trust. So basically, I own 1%. And that unit trust basically invests in those various securities. And those various securities give out a return, as you have seen. Bonds give out return in interest, equities give out return in dividends and capital appreciation. So those returns are distributed into the unit trust. And then the unit trust distributes that return to each investor in the proportion of their units, remember. So if I had 100,000, which is 10% of the fund, and the unit trust makes 100 million, I will get 10% of that 100. That is what it means. However, remember, the returns are not fully distributed to the investor. There is a charge, 2% per year, that is supposed to pay the service providers, which is the fund manager, the custodian, and the trustee. So, for example, if a unit trust is giving you 16%, and that is gross, remember, you have to deduct 2% from it, so you're getting net of 14%, because 2% goes to the fund manager, trustee, and custodian. So you need to be cognizant of that some of the money goes to pay the service providers. Now, in terms of responsibilities, the fund manager is supposed to send you statements every single month. Number two, the fund manager is supposed to publish performance of the unit trust every single day in the newspaper, except for holidays and weekends. And every month, the fund manager is supposed to send a fund fact sheet, which stipulates the performance of the fund for that month and give an economic indicator or commentary on what is happening in the economy. And they're supposed to send it to the investors. Number three, the fund manager, custodian, and trustee are supposed to hold annual general meetings every year where the investors can make and approve statements and also make decisions. Number four, there needs to be audited financial statements. So the fund manager, custodian, and trustee will employ an auditor to audit the unit trust. So that's the structure and the regulation. So that is now the other implementation option that you have as an investor. It's called unit trusts. Okay, so I will stop here And like I had promised, I'll give some moments for questions. So let's take 5 minutes to ask questions that are related to the particular presentation I've just made. If you have a question, please ask now, and then we can ask questions that are not related after. So I'll give it time also. So if you have a question, please use the chat function, or you can unmute, and I'll be welcome to answer your questions. Okay. Anyone with a question? Okay. So anyone now with a question that is not related directly to the presentation?
Yes, Rachel here.
Yes, Rachel.
I just joined towards the end. I was traveling from field office to Juba. Is
Okay.
it possible to share this recording, because I feel like I've missed quite important information? Over.
Yeah. The recording will be shared to you, including also the presentation. So you will get both the presentation and also the recording. Yeah. Great. Anyone else with a question that is unrelated to the presentation? Good. Okay, I have some few questions here, so let me tackle them one by one. So, question is, okay, start from Marion. Any tips on how to choose a fund manager? That's a good question. So I'll give a few tips. So number one is, okay, look at the management and look at their qualifications. Number two, technology. If the fund manager offers the product using an application or even USSD, the normal USSD, that is also good enough. So that's one thing I'll see. That's convenience. And number three, I'll also look at the rate. You also want a reasonable interest rate. So that one will help you choose which one is the best fund manager to choose. That's number one. The next one is, what happens when the unit trust makes losses? Is the 2% payment fixed or it varies? That's a really good question. It is fixed. It does not matter whether they make profits or losses. It is 2% of the money that is invested. So that is fixed. So when you're investing in an equity fund and the equity fund delivers a negative return, you also add 2% to that negative return, and you will see your total inclusive negative return. That is good. How can you tell that a property is a good investment? Oh, that's a hard question for me because I'm not conversant with property, but I'll give you from an investment point of view. When the property is giving you an interest rate that is commensurate to its risk, we said it's high risk. So the return on property should, number one, be higher than any government security that you're getting. That's a given. Number two, good location. The property needs to have some form of demand. So if you're in a remote area, the property is not a good investment because there's no demand for that property. So I'll say good location and good return, but that's just me. I'm sure you can get a little bit more insight from people who do property. I'm not well conversant with property investments. Marion, same question. Property funds. So these are funds that invest in property. So property is quite risky. Remember, I said property is risky. So it becomes less risky if the property fund is based on acquiring property that already are built and generating income. Things like rates. rates are less risky. However, if you invest in development property funds, I will not advise, because you're taking development risk. If the property does not get developed or something happens, your money has gone. However, for properties that are already built, the only risk there that involves is either you don't get tenants, which will lower the risk, but the property still exists. It can be sold, it can be liquidated. But for development, I will shy away from it. Again, I'm not an expert on property, so I cannot offer so many insights on that. But if it was up to me, I will shy away from property funds. Property funds are very risky. Yeah. Okay. Any other question? Also remember, you can unmute if you have a question. What about this environmental, social benefits other than cash? That is personal, Tesfaye. That is very, very personal. So if I'm to be objective, we're discussing basically money and investments. We're not discussing about environmental and social benefits, albeit is very important. Remember, it's very important. But for me to be very, very objective, there's no way I can quantify environmental and social benefits as a return on money. That's why we have to speak about cash on an investment class. However, remember when we're talking about the companies to choose, I can remember here, there was a section where we had good to haves and things like that. We had social responsibility and environmentally sound. These are things you can incorporate in choosing a company to invest in. But when it comes to investment returns, it is unfortunately based on cash basis. So you need to have a personal inclination to care about environment and social benefits for you to make it criteria for you. But as a trainer, I cannot speak to that and be very objective. I'll just have to include my own subjectivity on the matter. I'll just be selling to you what my environmental and social aspects should be, ideally. Do we have a service provider available in South Sudan? Sarah, service provider for what, ideally, if I understand your question? And someone was trying to speak.
Yeah, John,
Yes.
can I come through?
Yes, please do.
Okay, so I just wanted to, I'm not sure if the question was responded to. We just wanted to know if the 2% payment that is retained by the service provider is fixed. And also what happens if a unit trust runs bankrupt? Because we've seen some of the big names in the world invest in some of these unit trusts, and when they go bankrupt, they run broke, like they lose a lot of money. But I don't know whether there is a recovery kind of system so that when people lose, at least they're somehow compensated. Thanks.
Okay, that's the first one is on the 2%. 2% is paid, it's fixed. It's not based on performance, it's a fixed figure. So you have to pay it regardless if the company makes a profit or a loss. The other one, the recovery measure is on the regulation. Let me explain. If I invest, remember the unit trust is investing in government securities. It's investing in bank deposits. It's investing the same place you are investing. Remember that. So if those investments fail, they just fail. There's no recovery. However, on the regulation side is that the investment cannot invest more than 25% in a single issuer. So your money, if once something collapses, your money is limited to 25% that is going to be lost. The rest will be okay, because not everything will fall at once. Does that make sense?
Yeah, sure.
Yeah. So the only mitigation is on the regulation. But if a company fails, like you put money in Equity Bank as a deposit and then Equity Bank fails, there's no recovery measure there ideally, because it's an investment. There's that level of risk, and that's the level of risk they take. However, on the regulation, they limit not to put all their eggs in one basket. They say less than 25% in one single issuer. So the losses are limited to 25% on every single event. Yes, I saw Sarah asked, do we have a service provider available in South Sudan? For example, central banks and other banks like ACB. Yes, we have banks in South Sudan. We have a lot of banks in South Sudan. And I'm sure South Sudan has a central bank, definitely. Yes, we do. We definitely do. We definitely do. KCB and Equity are also in South Sudan. I'm not sure about Cooperative Bank, but yes, we do have service providers available in South Sudan. They're definitely there. What happens to your investment when a company is closing down? Charles, please speak on which investment. Is it equities or fixed income? Or I can speak to all of them ideally. So if you're a shareholder, when a company is closing down, remember you are the owner of the company. So ideally, you're the one who's closing down the company, right? It's your company. So it happens the same way. You have to pay everyone. You have to pay everyone that you owed. And then what is left is distributed to you as the owner. That is what we call equities. For fixed income, you will be paid first because the company has to pay its debts before they pay the shareholders. That is what happens when a company is closing down. So if you're a shareholder, an equity holder, you will be the last person to be paid, ideally. Yeah. Yes, Cooperative Bank too exists in South Sudan. Yeah, I thought so. Yeah. So we have several banks, local banks, even have some local banks, I'm sure. But even we have Kenyan banks in South Sudan that operate there fully. Yeah. So yeah. So you can actually go to them and ask, how can you get exposure to investing in Kenyan bonds if you want to invest in Kenyan bonds? But if you want to invest in stocks, you have to use brokers. And I'm not sure there are brokers in South Sudan. So you have to directly contact people in Nairobi. Yeah. I've seen companies buying back shares. Explain this to me, why it happens. Companies buy back shares because they see that the price is cheap. So the share price goes down and the company sees it's a way that they can actually buy more shares from the shareholders. They just buy. There's nothing else to do with it. It's just that they're seeing it's cheap and they can buy more. That's it. Nothing too complicated. So when companies have low share prices, sometimes the company decides to buy back the shares from their shareholders. Yeah. Thanks, Rosom. Okay. Take a final round of questions. Any other questions? Remember, this presentation will be shared to you and also the recording. So if you have a question that is unrelated, you can ask now before we wrap up. Okay. Okay. Thanks again for taking the time. Okay, Judith, do unit trusts attract interest taxes? Yes, withholding tax. Anything that you earn an interest on, let me just say it like that. Anywhere you earn interest attracts a 15% withholding tax. Anything that you earn interest on, be it bank deposit, interest on government securities, interest on unit trusts, 15% taxes on interest, not on your principal, on the interest. Okay, I think we can give it 5 minutes. Oh no, 1 minute to see if there are other questions before we close it. Okay. Okay, I think we can close it there. So thanks again for making the time. Thanks again for coming in. It's been a pleasure having you for the past, I think, 4 or 5 sessions. And I hope this will be a good start for you to start making investments, either on equities, either on fixed income, or either on shares, or even, what do you call it, unit trust funds. So take this information, don't sit with it, actualize it, use it to your own benefit. If you have questions additionally to what we have discussed, I have put my email address there where you can actually reach me on email. So I usually respond at the end of the week because there's usually so many. So if you send requests at the end of the week is when I sit down and compile all of them and answer them, but I will sure to answer them. And please take the lessons learned from these particular sessions and start. For sure, some of the investments might not work out as good as you wanted, but that's the risk you're taking. And once with experience, you'll be able to understand how they work and make the necessary investments. So thanks again. I think I can hand it over to you, Kathleen.